Goldman Sachs CEO David Solomon tells investors that the U.S. economy is heading towards a recession. CEO JP Morgan expects a downturn in about 8 to 9 months in the USA, while in Europe it is already in a recession. The International Monetary Fund chief economist, Pierre-Olivier Gourinchas, believes that the worst is yet to come. The World Bank has a say in the current economic situation. It declares that global growth will stand at 2.9% in the years 2023 and 2024, highlighting that per capita income growth will be 5% lower than pre-pandemic. Then compares current events such as the 1970s, when there was supply and demand turmoil, and whispers that almost all economies will face tough months. The European Central Bank and the Federal Reserve are no less. The ECB wants inflation around 2% as a target, stating that it will remain high at 5.1% for the year 2023 and 2.3% for the year 2024, and that inflation in Europe was 11.5% in November 2022 and continues to raise interest rates again. Clarifying that inflation is a global phenomenon, the other central banks also acted. On December 14, 2022, the Federal Reserve raised interest rate to its highest level in 15 years, to a targeted range of 4.25% to 4.5%. Bank of England brought interest rates to 3.5%, which is the highest since 2008, with inflation in the UK at 9.3%. The economy is a very complex subject, with enormous dynamics and variables at play. Institutional investors, in the case there is at least 2 consecutive quarters of negative growth of the real GDP of an economy, consider it a sign of recession or as a red signal. In the last 3 quarters, the economy has collapsed again with a contraction of the gross domestic product. Like so many financial and non-financial experts, it keeps saying that the recession is coming. You have to go step by step to get practical points of view. An interesting analysis of the behavior of households with money can give us much to think about. In the pandemic, an enormous amount of money has really been printed to buy state public debt and circulate the economy. A lot of money given to citizens went into the financial markets between 2020 and 2021, and a lot of other money was set aside as savings, therefore not in the real economy. Speaking of the USA, unlike other major European economies, there has been a lot of government aid, such as unemployment benefits and increased household incomes. At the end of 2021, they found themselves with truly enormous savings rates, creaking economies, and inflation taking its course towards the Himalayas. Over the course of the pandemic, U.S. households have accumulated nearly $2.5 trillion in excess savings, about 12% of GDP. You can see in the graph, every time there was help to families, savings increased. This is important if we consider that Americans have a bad relationship with savings. Now with inflation and savings rates high, many families can use part of their wealth to offset the rise in prices. It can already be seen from the graph, mid-2020 the savings rate was decreasing. Many people have reduced their consumption because they do not want to decrease their hard-earned savings. So income is not enough and the money saved has decreased. The dynamics of consumption and spending habits are changing. All of this has effects on the real economy. If you combine this scenario with high inflation, high interest rates, weak economies, sharply declining corporate income, and layoffs initiated like Shopify, Facebook, Twitter, or Netflix, draw conclusions for the coming months. Perhaps in a couple of quarters we could be within the scenarios that many economists have reported. Banks, hedge funds, and many economists anticipate the next recession with a 40% probability in the USA within the next 12 months. There are those who are more pessimistic, some less, but the probability seems to be the highest in the last 50 years. It looks like a scenario similar to hyperinflation in the late 70s and early 80s. Today, in Europe and the United States, annual inflation is currently between 10.1 and 7.1% respectively. The graphs may provide more clarity on central bank policies and interest rate increases. In this graph of Bank of America, we see the interest rate adjustments made by all central banks, about 243 interest rate hikes in 2022 alone. The forces driving inflation are very different between countries. In general, if you think of inflation, you think of the prices of food, energy, and transport. And if we compare the USA and Europe, we observe that in Europe inflation has been driven by the recent energy crisis. In fact, this can be seen with the red area of the graph. As the pandemic spread, it has already been observed that the supply chain has been a huge problem, especially for certain raw materials. Well, then we could deduce that demand is the main cause of inflation, especially in the USA. Assuming that the demand of a consumer for a good, such as a TV or a PC, increases, if the offer is unchanged or even lower, prices may increase. What we are facing are truly uncertain situations, also because an enormous amount of money has been printed. We have gone from 5 to 9 trillion in 2 years to face the pandemic crisis and avoid layoffs and serious consequences in consumption. We have entered a contraction of the economy without knowing the extent and duration. When money is printed, debt is created, and this has increased exponentially. Central banks are going to have to deal with it. We're talking about economics. which is very simple in theory but not so much in practice. It's not enough to print and double the money supply in circulation. It is true that there are short-term benefits, but it can also turn into a snowball that gains strength when going downhill if there are no obstacles in the way. It is unexpected inflation you hear from the top central bankers without questioning any step taken in previous years. Now, the economic policies implemented are unprecedented because just as interest rates are acted on so quickly, it has repercussions with the same speed on the financial markets, on the real economy, on mortgages, and on the real estate market. Not only that, but also repricing in the main asset classes as a result. Now that we have this huge and intricate puzzle, the important thing to do when interacting with financial markets and investments is to evaluate the current picture, accept it, have as much information available as possible, and act calculating the risks without too much fear. Remember the shock of 2020. One day, suddenly everything closes: offices, shops, national borders, free movement of vehicles and products. As a consequence, the economies of companies, families, and nations are paralyzed. As a remedy, the simplest thing to do is print money, lots and lots of money, and transfer it in some way to businesses and citizens, even directly to homes, to stimulate the economy as soon as possible. These stimuli are welcomed with open arms, especially in the financial markets, which live on sentiment, and after a year and a half from chaos, we start again. The market's flag recover ground from the lowest ever and reach the highest ever until the beginning of 2022. However, the tide always brings some debris, some small rocks, and we appear to be discussing large stones here. Mr. Inflation comes at a gallop with a horse as it hasn't happened since 1980, and we need to somehow intervene with demanding economic policies. This may be a very simple summary because reality is far more intricate. The pandemic has hit hard, especially the supply chain. In this case, it is right to bring China into play. China is the productive pool of the entire Western world. It too is closed down, limiting the economy, transport, and shipping. In China, however, inflation is not as serious as it is in the Western world because wages, production costs, and raw materials are more flexible due to the relationship between the government and the people. The issue is that many Western nations and companies, as well as companies from all over the world, get their supplies from China. Companies like Tesla and Apple, for example, complain about difficulties managing warehouses, inventories, orders, and deliveries, in short, the entire business cycle. Some of these companies are huge, they have a lot of liquidity, but they are also sinks where money is burned if logistics are not managed correctly. In any case, if China closes its borders as a large domestic market capable of working and consuming, it can absorb economic repercussions, but it creates problems for Europe as well for the USA and today's economy, influencing inflation with problems of supply. We should remember that interest rates have recently been in negative territory to stimulate the economy or the demand for goods and services. Central banks, among other tasks, must monitor the health of national economies and operate to contract the economy or expand them through interest rates. If there are low interest rates, commercial banks can access advantageous loans and consequently offer companies and individuals cheap loans for a mortgage, purchase of a house, or other assets. It is also true that in a phase of economic expansion, it is normal for prices to rise, and this is fine as long as inflation is around 2%. If inflation rises above the optimal rate, we see central banks doing the opposite, contracting the economy by raising interest rates just enough to bring it back to a more stable range. If inflation is too high as a result of excess demand, and there is a shortage of goods and services, central banks raise interest rates to cool the economy and wait for inflation to fall. This means it's more expensive to borrow money between central and commercial banks and between commercial banks and businesses or citizens. Not only, but if the economy cools too much, we risk a recession. These mechanisms are theoretical because the economy is far from easy to control. However, the dynamics in which a large part of today's economies find themselves are not strong, and therefore it is a different scenario from the theoretical one in which high interest rates are affected. Prices started to rise steadily years ago, and before the pandemic, salaries did not follow this trend. The closures in 2020 and 2021 only brought other problems, such as the one in the supply chains, which has caused prices to rise enormously even more, especially for food raw materials. In this interest rate scenario, if not carefully managed, can wreak havoc on the economies of households and businesses, impacting the real economy and those of nations. Thus, there is some link between the economy, interest rates, and inflation. Inflation is normal in the event of economic growth, with central banks raising interest rates to control and manage it at the optimal level of 2%. Today, we see that interest rate policy is not tied to lasting economic growth, but rather to inflation that has gotten out of control. Yes, you may recall that the central banks did nothing when inflation began to rise at the end of 2021, but the economy was recovering from a severe shock, such as the pandemic. Inflation has been low in the last 10 years owing to the central bank's accommodating policy in terms of interest rates and a constant injection of liquidity through quantitative easing following the 2008 crisis. In the various years from 2009 to 2015, the economy benefited from these monetary stimuli and inflation remained under control even during the failure of Greece in 2014, for example. It's very probable that the central banks, seeing inflation under control, had decided to observe the situation first, since the economy was not extremely strong. Now we find the European Central Bank and the Federal Reserve competing to see who can raise interest rates the most in the shortest possible time of an economy that was already creaking, and now the cracks are growing visibly. This report from Riverwater Partners confirms exactly what we are talking about. In 2022, the Fed raised rates by 300 basis points from 0% to 3%, and it is estimated that in 2023 there will be another 1 to 1.5% increase to reach 4%. Only in the early 1980s did the Fed raise interest rates so quickly. At the beginning of the 1980s, there was the second oil crisis, the coming to power of Khomeini in Iran, and the beginning of Saddam Hussein's war in Iraq. These events led to a drop in oil production, an increase in the price of crude oil, and a sharp rise in inflation. Also, from the graph, we can deduce that there has almost always been a management of interest rates in small steps to accompany the economy. We saw it in the late 90s, for example, that to stimulate the economy during the pandemic, interest rates were brought almost to zero, followed by a very sharp surge at the beginning of 2022. Now the central banks are running for cover. While this didn't happen by accident, as a result of the pandemic, there have been closures around the world, restrictions, supply difficulties, and monetary stimulus never seen before on the economy. All of this has consequences, and that's what we can deduce as a response to the current situation. Today, managing investments is very complicated for the investor. It was easy in 2021 when the markets were extremely bullish and taking very high risks because prices of many instruments looked so high. There are expert investors who know how and where to find right information, be months and weeks ahead, and know how to position themselves correctly in the markets, capable of aligning themselves in some way with future market rebounds. This is because the markets are not the economy, or rather decisions cannot be made based only on economic data or predict what will happen because nobody knows the future. So you, who are certainly ahead of other people who would like to invest their savings or manage them better. You know that you can't have a clear idea of how to deal with current uncertainties, and you have to learn the hard way or with the help from expert investors with a planning of actions to be done with step 1, step 2, and so on. You don't have to be afraid to invest your money. While you wait for the perfect conditions, the opportunities will already be gone. Speaking in detail about the stock market, those who are familiar with it and are competent know that even if the markets increase in volatility, one wrong decision can have a huge impact, but they also know that the prices of many shares will go at a discount, with prices more reasonable than 10 to 11 months ago. In addition, it must be said that even if everyone is calling for a recession and is sitting there, waiting for the data to confirm these scenarios, it is also true that now the world has opened up again. So by checking the news on the markets, the graphs, and economic data, you can plan investments with opportunities on the horizon or even rebalance your portfolio. Each investor is in a different investment phase, but for simplicity, we're going to distinguish two types: those who are in an accumulation phase and those who are in a consumption phase. In an accumulation phase, the priority is to continue to put money aside and invest it continuously. Therefore, the volatility on the market matters relatively, since psychologically, you're ready to face days or weeks of decline. If, on the other hand, you find yourself in a situation of consumption, you have most likely invested for some time and want to withdraw or constantly manage your wealth. Therefore, you need to contain some volatility. Let's think about the performance of the S&P 500 in the graph. We observe a downward peak in 2022. In fact, it lost about 35% in real terms, a horribilis year for many investors because it is a point similar to other critical events of the past. Almost 150 years of history where there have been so many crises. You may have heard that in the last half of the year, many companies released estimates of continuously declining profits and very weak or slowing corporate economies. The main global stock markets think in sentiment and expectations. Many stock markets and individual shares have been in negative territory for months with false rebounds because of the pessimistic sentiment on inflation, central bank policies, wars around the world, energy crisis, and unemployment. Another milestone for these periods is to avoid common mistakes that can be made. The former may be associated with staying on course. An example, the S&P 500, which has really lost a lot of ground. This highlights the fear of many investors who have liquidated or are liquidating positions too quickly and without maintaining the strategy for their investments. The mistake is to think about going short and buying short, because if you try to stall for time when the market goes down, likely you will lose gains during the recovery. A second mistake concerns limiting investments on high volatility time. There are those who sell when the market goes down and others who avoid investing. Probably there is only a problem of perspective. Those who are ill-informed or unskilled for certain situations focus more on the potential losses instead on opportunities for future gains. In both cases, discipline, knowledge, and stress management are some of really solutions available. If you are interested to know which steps you can take to invest or preserve your savings during the crisis and outside the financial markets, I really recommend you to watch the second part of this video. The link is down in the description below. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.